Well, welcome everyone. Thanks for joining us. We have an exciting webinar tonight. We'll go over um, why bonus depreciation is higher than it was when we originally purchased this deal, which is very exciting. We'll go over mistakes investors typically make around this time of year. We'll talk about what we have currently available and why we think it's a compelling time to invest and why it's a compelling time to invest with us in particular. So my name is Gary Lipsky. I am the president and founder of Break of Day Capital. I'm joined by Andy and Joe on our investor relations team. And not only are they on our team, but they're also investors in our deals. A little bit about Break of Day Capital. We focus on quality over quantity. We've only done 3 deals in the last 3 years. We've raised over $100 million to date, distributed over $40 million to investors. We currently manage over 1,400 units in Arizona. We have previously sold 400 units from our portfolio. And asset management is something that we take tremendous pride in. I wrote a best-selling book on that. Tim is our asset manager, and he is a great asset manager. We've averaged a 40% bump in NOI in year one across our portfolio. So it's really been a strength for us. You can go to the next slide. So I mentioned some of the team members, but we also have Sean who helps with operations. Jacqueline, you probably heard of. She does all the behind the scenes stuff. Um, Keeps the engine running. So great team. Like I said, uh, the team invests in our deals, which is great to see. Go to the next slide. So we have aligned interests. We do things a little bit differently than other companies. Um, Tim, who is our asset manager slash acquisitions, he sees it from cradle to grave when we look at a deal. So it's not someone that's handing off an acquisitions and then giving it to operations to say hit my numbers, execute on the business plan, and there's a disincentive that way. The acquisitions person is incentivized to get deals, and the operations person has to live with those. But having someone from cradle to grave means he's going to only get us in the best deals possible because he will only benefit if a deal does well. If a deal doesn't perform, he's not going to make um, his money. So that's really important to us. So full alignment. Like I said, I'm one of our biggest investors in all of our deals, and the team invests as well. Um, and every decision that we make is managed with the same discipline and diligence we expect with our own capital. So we're not a company that focuses on multiple asset classes and territories all over the country trying to find a quote unquote good deal. We focus in the Southwest, and we've done so far all of our deals in Arizona, even though we've been on stuff in Vegas and Albuquerque and Salt Lake City. Tim's managed over 1,400 units in Vegas. So most of our properties have been in Tucson. We'd like to diversify more in those markets that are landlord friendly, that have above average population growth, and job diversity. We've seen the best deals where we bought so far, but we do want to continue to diversify more in the future. We currently own 9 properties, like I said, and you'll see that in this portfolio and the 4 that we've sold and the returns on the bottom right. We can go to the next slide. And I'll pass this on to Joe.
Thank you, Gary. Uh, Good evening, everyone. Thanks for joining us. For the rest of the webinar, we're going to take a deeper dive in looking at a couple of our current opportunities. But before we do that, I do want to start with some guardrail comments, just some things that you should be considering if you're not already thinking about it. Okay, so what are some of those things? If you ever been on a call with me, I usually like to start, looking at your overall portfolio. I'm a big, strong believer in, having a tranche of money that you need to pay your bills with, and then another tranche, another tranche of liquidity where you would like to earn, some yield, but you might not need the money immediately, maybe like a year out. And then, then you go further out the risk curve, where you're maybe looking for tax benefits, or maybe more equity growth, some tax deferred, appreciation. So with that said, one thing that you should be considering when you're evaluating these two current opportunities that we have is if you're needing, to kind of add more to your cash flow bucket, or perhaps, you might be, in the process of selling a real estate a property in which you may need tax benefits. So we're going to go into that a little bit more over the next few slides. Something to also note is that if you are paying attention to the macro environment, you probably heard, I think as of December 1st, the Fed has finally officially ended quantitative tightening. That means going forward, and we don't know exactly what the rate's going to be, but they will start to expand the balance sheet again. So not quite quantitative easing, but we're sort of headed that way. And then also with that, you can expect interest rates to start getting cut. It's been a little bit volatile, but right now there's about an 80% probability that we're going to get another 25 bips cut in December, and probably another one in January. And depending on, who Trump gets to assemble, the next Fed Board of Governors, the rate cuts might be even more dramatic than we're currently expecting. So that's just my long-winded way of saying that, you can probably expect rates to drop considerably over the course of the next year. Also, wait, Andy, can you just back that up? I'm almost done. Sorry, I'm a little long-winded. Yeah, just remember that, when if you're looking for whether you're trying to execute a 1031 exchange, or you just want to deploy some capital by the end of the year, you know, um, I get that. We all have time constraints, but deal quality is still number one. Just don't ever be forced to invest in a bad deal. And one way to evaluate that is, when you interview your sponsors, ask them some tough questions. Just how they have operated. And actually in recent years, it's been a challenging market on multiple fronts. Okay, just a little bit more. So, as I mentioned earlier, uh, don't don't just invest in a so-so deal, or hopefully not, but a bad deal just because you're chasing after tax benefits. As many of you know, bonus depreciation got reinstated, and one of our deals right now that's available today can offer you upwards of 90% plus bonus depreciation. So just keep that in mind. Um, and also, I mentioned, when you're trying to execute a 1031 exchange, you only have a certain amount of time, something like 45 days to identify and 6 months to close on your exchange leg. But also, consider that there is an alternative. There's a lazy 1031 um, exchange, which we can get into a little bit in subsequent slides. Um, I kind of mentioned this in the previous slide. be careful when you're talking to sponsors. When you look at their projections and they don't seem realistic, that's a pretty, or if they sound too good to be true, that's an automatic red flag. Some of my own personal pet peeves are, projected IRRs are way too high for a particular project. Or if you see like a year one rent growth that is just really, really high, like we've been operators for many years. It's just not something that we typically see right away. Although, even though it could be possible. And then another one is if they're projecting a reversion cap rate, that's the cap rate in which a deal is being exited at. If it's really, really low, that's also another way to artificially make numbers look really good. Okay, so as we get into our two current offerings, uh, we have Icon on Headley, and then as well as our preferred income fund. Depending on what your needs are as it relates to your overall portfolio, Icon Headley is one of our current syndications where you'll be able to enjoy you actually be able to take advantage of immediate tax benefit of 90% plus bonus depreciation in year one. So basically tax year 2025. What that means is for every $100,000 that you invest in this deal, you will receive $90,000 in passive losses that you can use to offset your passive gains. Um, you'll also be receiving income and as well as potential appreciation, equity growth on the back end when we exit this property. To date, uh, we have distributed over $165,000 on this deal, so you can clearly see that it's cash flowing really well. On the other end of the spectrum, we have a diversified preferred income fund that pays a fixed dividend, if you will, and it is diversified across multiple properties, and it's great. It pays very high returns, very high income rate compared to what's available out there in money markets and CDs, especially when you take into context of a falling rate environment. And to date, we have distributed over $478,000 in this fund. Okay, I'm gonna take a little breather and hand over the next few lights over to Andy, where he'll talk more about Icon on Headley.
Thanks, Joe. So yeah, this page is the high-level overview of Icon and Headley. It's a 1999 build, a Class B plus property with 136 units. It has a good mix of strong mix of 2 and 3 bedroom units, which is attractive in Tucson. As Joe just mentioned, we just recently got an updated bonus depreciation number for 2025. We initially expected in the 80 to 85% range, but it's actually going to come in the low 90% range. So that's pretty compelling for investors looking for the tax benefits of that. Distributions have already begun. So classes B and C already paying distributions. The early January 2026 distribution is scheduled to be annualized 3.5%. And we're going to look to bounce that up to 4 and 5% over the next year or so as net operating income stabilizes and we get to the property to the point that it's currently at. So, we like this property because its location. It's located near 3 other break of day properties, so it helps us it gives us better information about the area because we know the area well. The leverage is conservative at 64% loan to value ratio, and it's in a fixed rate loan at 6.34%. So we think, with the bonus appreciation, the fact that we've de-risked it a lot, which we'll go over in the next couple pages. It's a pretty compelling advantage for investors right now. So currently, here's the current pictures, property photos of Icon and Headley. So you can see the conditions of the property. It's clean exteriors, updated amenities, and well-maintained common areas. So the unit interiors are already the unit interiors already present a modern feel, so we're only doing targeted upgrades as needed. The clubhouse, pool, and other outdoor areas already reinforce a Class B plus positioning. So these visuals explain why our renovation plan is on the lighter side and not a heavy reposition. So this next page talks about the capital stack and use of funds. So the capital structure includes senior debt, soft preferred equity, and then common equity. And so as I mentioned before, the senior loan is at a fixed rate of 5 years and 6.34%. The soft preferred equity layer adds downside protection for common equity holders. And so the use of funds, you can see on the right, there's a purchase price, closing costs, capex, working capital, and the standard acquisition fee. So the renovation budget is modest relative to the asset size. So you see the capex, which we'll go over the next page, is only 833,000, which is a lot less than your heavier lifts. And so we think that's another reason why this is a not as large value add and not as risky of a deal for investors. And so now we're talking about, why Icon and Headley is a good investment now. So we've stabilized it post acquisition. And so early on, Headley experienced delinquency and economic or in vacancy issues. So this is pretty common when we first take over property. Sellers have a incentive to make the rent rolls look as good as possible, so they try to get the occupancy up without really taking into account the quality of the tenants. And so when we usually take over property, it takes a quarter or two to clean out all the non-paying tenants, and just the tenants that we wouldn't normally approve for our property. So it just takes some time to get to that point. So we feel like we're at a point where it's now stabilized with our post-acquisition challenges. We've addressed collections, we tightened screening standards, and as I mentioned, we replaced the non-performing residents. So most of the heavy lifting is already done, and so that's why we think investing in Icon and Headley now is more of a de-risked investment. And so the business plan is pretty straightforward. So, we already rebranded to Icon and Headley. It was formerly called La Posada. And so that just rebrand just aligns with all other properties in Tucson with the Icon brand name. So it improves our portfolio consistency and brand name. And so as I mentioned before, this is a lighter renovation. So only about 13% of the remaining units haven't been updated. So those will be updated as needed going forward. We already did a couple of things around the property. So we already added a dog park and accessories. So that's a nice amenity for tenants. We added a pergola and 2 barbecue pits in the pool area, as you can see in the picture on the right. That adds a more resort experience for tenants. We feel like these things on the margins will add a lot of value to tenants and hopefully get that occupancy and rental income up over time. And so, as I mentioned before, the renovation budget's on the lighter side, but you can see the list here of where exactly the renovation budget is allocated to. And then, so the pro forma. So as Joe was saying earlier, in terms of sort of looking at red flags and making sure that sponsors aren't projecting overly rosy projections for their investments. So for our pro formas, our revenue growth is driven mostly by rent to the market alignment, meaning we're increasing rents on the margins to get in line with the market. We're not increasing rents to try to get from a B plus property to an A plus property pricing. So it's again on the lighter side. Expenses follow normal inflation patterns in terms of payroll, repairs, taxes, insurance. So one thing to look for in certain pro formas if they have a lot lower expenses projected into the future. Everyone knows now that for example, insurance rates are a lot higher these days. So those are the things that we account for to make sure that we're capturing everything at a more conservative basis when we're looking at the pro forma. So the NOI growth in this pro forma reflects a light out value add strategy and not a major redevelopment. And finally, so these are the various investment share classes. And so for the investors who are interested in bonus depreciation, that's really classes B and C. So classes B and C are the same. It's just class B is for larger check sizes. So we call that our institutional share class at a 500,000 minimum. The main difference is the preferred return is slightly better than Class B, and the waterfall is slightly better for those larger check sizes. And then Class A is our preferred equity share class for investors that want more of a fixed income alternative. So Class A pays a monthly distribution, an annualized distribution of 10%. Just keep in mind that Class A is not eligible for bonus depreciation, while Classes B and C are eligible for bonus depreciation. And so those are at the 90% plus projections. And this return projection page is sort of illustrates to our investors what their returns would look like over the 5-year hold. So as I mentioned before, we're currently paying about a 3.5% distribution, looking to get it up to 4 and 5% over time. With a $100,000 illustrative investment, you'll see the annual distributions every year. And then at the end, when we sell the property, investors first get their initial capital back, and then the proceeds from the sale is when the waterfall splits happen. So this is just a way to illustrate what a 100,000 investment is projected to earn over time. So this comes out to, we project about a 15% net IRR annualized, and that comes out to about a 1.9x multiple over a 5-year hold. And then finally, this is the sensitivity analysis. So as what Joe mentioned before is there's some sponsors who will project overly rosy exit caps, which may or may not happen, but this matrix kind of shows the various scenarios. So if you see the table, the box in the middle in the gold, so that's our base case projection. So if we hit our 15% IR over 5 years, we expect to hit a multiple of 1.87x. So the way the table works is, okay, let's say that when we sell and vacancies at 7%, what do we expect the returns to be? And you'll just move to the box one to the left. So that the vacancy is better than expected at the time of sale, then our returns are going to be a little bit higher than expected. Similarly, this assumes a 5.4% exit cap. And so this scenario will also show you, okay, if the exit cap environment's a little bit better than we expected, what would the returns look like? So in this example, if the exit cap is 50 basis points better than what we expect, so instead of a 5.4 but a 4.9, then you can see the projected returns would be 18.3% and a 2.2x multiple. So that just gives investors an idea of the various scenarios that can happen and what the projected returns would look like. And so with that, I'll turn it back to Joe, and we'll talk about the preferred income fund.
Thanks, Andy. Okay. On the other end of the spectrum, this is a fund that's really focused on providing current income. This is an evergreen fund, so this is a product that a lot of our investors ask for, and it's really a great way just to park, some idle cash that you may have. So what you can expect to get out of this fund is that you can expect that there will be reliable fixed monthly income. And that yield, the projected, actually, it's not even projected, it's a contractual, it's what we promise to pay you. And it doesn't change. It's actually quite a bit higher than your typical CDs and money market funds. And in fact, several other liquid instruments, which we'll show you in the next slide. So wait, Andy, can you go back? I'm not quite done yet. Yeah. Yeah. And yeah, so just, think of it as it's a relatively, safe, predictable passive income that, sits on the more current income side of your portfolio. Okay. What just for those of you who do not know what preferred equity is, what it is it's a special tranche of the equity portion of the capital structure. The capital stack is basically our assets are financed by either debt or equity. So debt is basically the money we borrow from the bank. Equity is basically capital that our investors contribute to the deal, right? So this is a part of the equity that sits between debt and the common equity. And so what this is basically it's a trade-off where you're electing to receive a fixed return, but in return you get priority should there be a capital distribution. So you'll get your money back first before the common equity investor will. These things are not priced on a day-to-day basis, on an hour-by-hour basis like the stock market. So, for all intent and practical, purposes, there's no volatility. There's no fees. It's a net 8% to you. We actually have a couple different classes, which we'll get into in subsequent slides, but there's one that will pay you 8% annualized, and then there's another class that will pay you 12% annualized. So as you can see, the returns are quite high. One other thing that's really important to note is that this fund basically invests in the preferred equity tranche of our subsequent of our some of our current deals and in upcoming deals. This fund does not invest uh, in deals that are that are in need of cash flow. So it is not rescue debt or some of the other funds that you may have heard of out there that's really designed to sort of help deals that are struggling, but that's not what this is. So this is a great illustration how the preferred income fund compares to various other competing instruments. On the lower end, you have money market, doesn't have a lockup. It's paid monthly. Anybody can get this in their brokerage account or with their bank. This something this is something that I have as well, and you can see that the rate has been going down. This was like kind of in the fours and fives, a couple years ago. Now it's in the threes. And if Trump gets the Fed that he's trying to engineer, I actually read a report today that they're expecting short-term rates to drop into the twos, which means very likely you could probably expect to see money market funds in the twos in 2026. CDs will also trend down as well. Plus you have a 1 year lockup, and if you decide to pull money out early, you usually have to forfeit all of the interest earned, and sometimes there's even a penalty. Fixed annuities, this is something that I personally don't like. This is a structured product designed to make investment banks rich. These things are full of fees and really, they have downside protection, but it has very limited upside. And so with that, you're looking at 5, 6%. This is barely keeping up with inflation. Um, and then just to uh, talk a little bit more about our income fund, we have one class that pays 8% annually. It has a 90-day lock, um, but you after that with the written notice, you can have your capital back. And then we have another class that has a 3 year lock where you are receiving 6% annually uh, on a monthly basis, and then you'll also be accruing an additional 6%, which can be paid in full in arrears at the end of the 3 year commitment. So you can get a total return of 12 years annualized.
Hey Joe, before we move on, just wanted to quickly mention for that Class A for the preferred income fund with a 90-day lock. So we have some investors who have money to park while waiting for our next deal. And so they'll move money into the preferred income fund. And then when the next deal happens, they'll just transfer from the PIF to the new deal. And what I want to point out is if that new deal happens to be within the 90-day lock, we won't hold you to that 90 days. So let's say you're only in the fund for 45 days and we have our next deal, we'll just simply allow you to move from the preferred income fund to the new deal, even if it's under 90 days. So just wanted to point that out.
Yeah, that's an important point. Thank you. Okay, so this is we're getting a little bit more granular. So I'm just gonna kind of reiterate this again. So for those of you that are looking for a fixed high yield, but maybe needing your money back in 6 months or a year. Maybe this is money you don't need for a while, but you still want to earn more than 2-3% on it. Class A would be a really great vehicle for that. Um, just to kind of reiterate this, there's an initial 90-day lockup. We don't want people to use this as their personal checking account. We want you to come in and enjoy it for a while. So there's a 90-day lockup, and then after, uh, if you really need your money back, let's say in an emergency, or you just need it, and after some time, a 30-day notice is all we need, and then we'll give you back your full capital back in full. Sometimes we can actually do it even sooner than that, but it just really depends on the situation. And then once again, Class C, and this is just for people that again don't need depreciation, not interested in any equity, don't want to think about uh, potentially higher returns, and then they're just happy with the fixed 12%. 6% paid upfront, and then another 6% accrued at the end of 3 years. So that one, you're basically committed to the fund for the entire 3 years. And then after that, it's a 30-day notice to for withdrawal. Okay, finally, just to kind of wrap it all up. So again, we have these two current opportunities that are available to you right now. One is great for one of the best combinations of significant tax benefits, in the form of a 90% plus bonus depreciation that you can use right away. And again, this is great for people that have passive income that you need to mitigate, or if you're selling, property and you either are trying to execute a 1031 exchange, or even a lazy man 1031 exchange. And real estate has it's been millennia that it's always known as a great inflation hedge. So we I don't know if we mentioned this earlier, but unfortunately the Fed's going to have to print more money, and that just means that asset prices will go up, to commiserate. I mentioned this before. These things are not priced on a daily basis, so you 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 won't see any volatility. And this is actually unique to Icon on Headley, which is that we bought it at much lower prices than replacement cost. So it would actually cost more to build one of these today. Excuse me. And it's in great condition. So um, that this would be, Icon and Headley is something that's great for people looking for depreciation, some income, and then potential appreciation down the road. And preferred income is pretty straightforward. Just this is really really geared towards someone that wants current income. This is great for retirees, and it's diversified across multiple properties. Um, so there we have it.
Okay, Joe, thanks for that going over the preferred income fund. So yeah, if anyone has any questions, maybe we can go over some Q&A. But yeah, if you're interested and you have want to learn more about these opportunities, you can shoot me an email at andy@breakintocapital.com or scan the QR code. Let me see if we have any questions.
No, no, no questions so far.
Okay.
Give it a minute if anyone has a question. You just put in the Q&A.
Yeah, I haven't seen any come through.
All right, here we go.
The question is, why is Headley still looking for new money? And so, yeah, so earlier this year in December 2024, we closed on Icon on Midvale, which is the sister property of Icon on Headley, and we closed Icon on Headley in March of 25, so a couple 2 or 3 months apart from each other. Between those two raises, we raised about $20 million total. And so a lot of our investor base already came into both of these deals. We just usually don't have two deals so close apart. And then on top of that, we started having a little bit of global volatility from all the tariff talks and things like that. So we just had a general slowdown. So currently we have about, a few $100,000 left for our allocation. And so that's the reason why we're still raising for Icon and Headley.
Andy, if I could just add to that,
Sure.
I don't know if people remember, but it wasn't that long ago. It was actually in April, which is like a month after purchasing Headley, that the tariff, what was it, Liberation Day?
Mm.
If I don't know if people remember, but the stock market went down 20%. So
Right.
people, people were really nervous. They didn't want to do anything.
Right. I think a good way to sort of think about that now is, we have lower rates. Hopefully, the Fed will be lowering rates even more in next year. And so, if interest rates do end up falling as projected, I mean, now feels like a really good time to be going into these types of investments that can get a tailwind from, general rates falling across the economy.
Any other questions before we sign off? All right. Well, appreciate everyone joining us. If you have more questions, like Andy said, reach out to him, reach out to Joe. You can even reach out to me. We appreciate you taking the time tonight to checking out some of our offerings. And like Joe mentioned earlier, don't chase depreciation. I've seen so many people get burned in the past at the end of the year. Don't chase projected IRR because I've seen too many people get burned by that as well. Go with a trusted operator, and you're here tonight because you trust us. That has a great track record that focuses on quality over quantity. And we appreciate you and have a great holiday season.
Thanks, everyone.
Thank you.